Okay, I want you to picture a business
Mm.
that is, by almost every metric that matter in the corporate world, a fortress.
Right.
We're talking about a company that absolutely dominates its sector, the Indian wedding market. It has zero debt issues.
Uh-huh.
It has profit margins that are so high they actually look like typos on a spreadsheet.
Mm-hmm.
And it's a brand that's become almost synonymous with celebration in India.
It sounds like the kind of stock you buy, tuck away in a drawer and then retire on 10 years later, the ultimate safe bet.
Exactly. That is the logical assumption.
Mm.
Ideally, the chart for a company like that should look like a staircase going up to heaven. But then
Then you look at the chart.
you pull up the stock chart for VEDANT Fashions Limited, and instead of a steady climb, you're looking at a catastrophe,
Hmm.
a black diamond ski run going straight down.
Oof.
We're looking at a stock that was trading at over 1,400 rupees not too long ago.
Hmm.
But today, Monday, January 26, 2026, it's sitting at roughly 484 rupees.
That's brutal. You're talking about nearly 2/3 of the company's value just evaporating? That isn't a correction. That's a collapse.
It is.
If you held this stock from the peak, your portfolio is bleeding.
And that is the paradox, and frankly, the mystery we're trying to solve on this deep dive. We have two conflicting piles of evidence on the desk today.
Okay.
On my left, I have the glossy investor presentation from October 2025, covering the first half of the fiscal year 2026.
Yeah.
It tells a story of growth, expansion, and dominance. It's all sunshine and rainbows.
And on the right, we have a technical analysis report that looks like a crime scene investigation. It's just flashing red signals, warning investors to stay away, screaming, "Strong sell!"
So our mission today is simple but critical. We need to figure out who's lying. Is the market being irrational and ignoring a gold mine?
Or is the financial report hiding a structural crack in the business that the chart has already spotted? It's the classic battle. Fundamentals versus sentiment. The weighing machine versus the voting machine.
And right now, the voters are revolting.
They certainly are.
Let's start with the empire of celebration, as I like to call it. Because when you look at the company's own report, this is VEDANT Fashions, the parent of Manyavar, the sheer scale of the operation is startling.
It's massive, and empire is the right word.
I knew they were big, but I didn't realize how big until I dug into this October deck.
If you look at their footprint, they're operating 671 exclusive brand outlets. We usually call these EBOs. That covers almost 1.8 million square feet of retail space.
And this isn't just a Mumbai and Delhi story, is it? Because usually, fashion brands just stick to the metros.
Not at all. That's a key part of their defensive mode. They're in 257 cities and towns across India. They're in the Tier 2 and Tier 3 cities where wedding culture is just as massive, if not more so.
Right.
But what's fascinating is how aggressively they're chasing the Indian diaspora. They now have 16 international stores. We're talking the USA, UAE, Canada, the UK, Australia.
So they're following the non-resident Indians.
Essentially, yes. Wherever an Indian wedding is happening, they want to be the ones dressing the groom. And if you've ever attended an Indian wedding in New Jersey or London,
The budgets are huge,
the budget for outfits is often even higher than it is back home.
which is smart. The big fat Indian wedding is pretty much recession-proof.
Mm.
But I want to drill down into something you mentioned earlier about the margins.
Oh, yeah.
I saw a slide in the presentation that claimed a gross margin of 66.1% for the first half of fiscal year 2026.
That number it's staggering.
Just for context, for our listeners who might not follow retail stocks that closely, what's a normal margin for a clothing retailer?
In standard fashion retail, you're usually happy with 50%, maybe 55% if you're a luxury brand or have a really tight supply chain.
So 66 is.
To hit 66.1% is industry-leading economics. It means for every 100 rupees of revenue, they are keeping 66 rupees after paying for, the fabric, the tailoring, the direct costs. It's an incredible cash-generating machine.
But how? How do they maintain that when everyone else is fighting price wars? You walk into a mall, and every other store has a red sale sign in the window.
This brings us to their secret sauce. It's a policy that defies the laws of retail physics. No discounts.
Ever.
For the core Manyavar brand, no. No end-of-season sales, no buy one, get one free, no Black Friday slash and burn.
That sounds incredibly risky. I mean, the average consumer is trained to wait for a sale.
Of course.
If I see a shirt I like, my instinct is, I'll come back in 2 months when it's 40% off.
And that is exactly the consumer behavior they've broken. By never discounting, they create what we call aspirational value. If you know the price is the price, whether you buy it today or in 6 months, you stop waiting.
You buy it when you need it.
You buy it when you need it. But financially, the impact is even more profound. It eliminates dead stock.
Right, let's unpack that. Dead stock. In fast fashion,
Hmm.
like a Zara or H&M inventory, has a shelf life, doesn't it?
Exactly. In fast fashion, if a floral print shirt doesn't sell in 6 weeks, it's trash. It's obsolete because the trend has moved on. So they have to mark it down by 50%, then 70% just to get rid of it. That just kills your margins.
But a Sherwani doesn't really go out of style.
A classic look is a classic look. A traditional cream-colored kurta, that design isn't going anywhere.
So they can hold the inventory without it rotting on the shelf.
Precisely. They don't face that obsolescence risk. They don't have to panic sell inventory at a loss just to clear shelf space. That discipline is exactly what protects that 66% margin.
So looking at the H1 FY26 numbers in the report, that discipline seems to be working. On the surface, anyway. Retail sales grew by 13.8%. Revenue from operations is up 7.2%.
And I would argue the most important number there is the SSSG same-store sales growth. That was up 8.2%.
Can you clarify that for us? Why does SSSG matter more than just total sales?
Think of it this way. If I double my store count, my sales should, roughly double. That's just bought growth. It costs money to build those new stores. SSSG tells you if your existing stores, the ones open for more than a year, are actually selling more than they did last year. An 8.2% jump there proves demand is rising organically.
It's not just expansion, it's attraction.
Exactly. Customers are walking into the same old shop in the same old neighborhood and buying more.
Okay, so if I stop reading there, I'm thinking this is a bulletproof business. They're growing, they make huge profits, they have pricing power.
Right.
But they aren't just sitting on the Monuvar brand,
Mhm.
right? They seem to have realized that being just the Sherwani guys has a ceiling.
Correct. The portfolio expansion is the next phase of the story. They are aggressively trying to own the wardrobe for the entire family, not just the groom.
I've noticed the Mohe stores popping up everywhere, often right next to the Monuvar outlets.
Yes, Mohe is their play for the bride and the bridesmaids. It has actually become their largest brand by store count for women's celebration wear. It's a huge market.
And much more fragmented than menswear.
Way more fragmented, so there's a lot of opportunity. Then you have Twamev.
That's the high-end one.
Right. Twamev is positioned as a competitor to those, boutique designer studios. It's luxury, exclusive, higher price points. It's for the customer who thinks Menuvar is too mainstream.
And on the other end.
They have Mibaz, which is a heritage brand specifically for the South Indian market, Andhra and Telangana.
It seems like they're trying to cover every demographic and every price point. Which brings us to the new kid on the block, Daiwas.
Launched in 2024. This is arguably their most strategic long-term move, even if it isn't the biggest revenue driver yet.
Why is that? What makes Daiwas special?
Because it targets Gen Z. Look, put yourself in the shoes of a 22-year-old attending his college friend's wedding.
Right.
He doesn't want to wear a heavy brocade Sherwani that costs 30,000 rupees. It feels outdated, it's uncomfortable for dancing, and frankly, it's too expensive.
Right, he wants something that looks cool on Instagram but doesn't break the bank.
Exactly. Daiwas is positioned as value to mid-premium. It's lighter, uses more sustainable fabrics, and it's cheaper. It fits the vibe of a younger generation.
So it's the gateway drug.
It's the funnel, essentially. Yes. They catch you with Daiwas when you're a guest in your early 20s. Then, a few years later, when it's your turn to get married, they upgrade you to Manuvar.
And maybe Twamev when you're older and richer.
It creates a full life cycle ecosystem.
I also have to geek out for a second on the operations side. The presentation mentions an automated replenishment system that works at the PIN code level.
Yes.
That sounds like something Amazon would do, not a traditional clothing retailer.
This is where being a large corporate player gives them a massive edge over the local mom-and-pop shops. They aren't guessing. They use AI and data to forecast demand for specific neighborhoods.
So they know that a specific shade of mustard yellow sells better in Bandra, Mumbai than it does in Tinagar, Chennai.
Precisely. And they ensure the stock is routed accordingly. This minimizes inventory waste. If you have the right size and the right color in the right store, you don't miss the sale.
And again, this feeds back into those robust margins. It's a very tight ship. Okay, so we've established the bull case. The ship is tight, the engine is running, the course is set. The fundamentals look great.
Yeah.
So, why is the ship sinking?
This is the pivot point. We have to put down the glossy brochure now. We have to look at the reality of the market.
Right.
Because if the business is so undeniably good, the stock chart shouldn't look this ugly.
We're recording this on January 26, 2026. The stock is hovering around 484.50 rupees. Just to remind everyone, this was a stock that people were happily buying at 1400.
It's a multi-year low. And it isn't just the price, it's the trend. The stock has broken through every major support level. It's trading well below its 50-day simple moving average, which is at 579 rupees.
Let's pause on moving averages. I know traders love them, but what are they actually telling us in plain English? Why does that 50-day line matter?
Think of a moving average as the consensus of value over time. The 50-day average is what the market thought the stock was worth over the last 2 months. When the current price is below that line, it means investors today are more pessimistic than they were on average recently. It means the mood is souring.
And it's even worse regarding the longer term, right?
Much worse. The 200-day moving average is up at 707 rupees. Being this far below the 200-day line confirms a strong, persistent bearish trend.
Meaning the momentum is overwhelmingly negative.
Every time the stock tries to rally, sellers just step in and smack it back down. The market is essentially voting with its wallet, and the vote is a resounding no.
But why? If sales are up 13%, why are sellers smacking it down? That's the piece I don't get.
That is the disconnect. The technical analysis highlights an indicator called the RSI, the Relative Strength Index. This might give us a clue about the intensity of the selling.
Okay, decipher RSI for us. Is it like a FIFA thermometer?
A bit like a speedometer for price changes. It runs from 0 to 100. Usually if it goes above 70, the stock is overbought, too expensive. If it drops below 30, it's considered oversold, meaning the selling has been too aggressive.
And where is VEDANT Fashion sitting right now?
It's at 13.08.
13.
Yeah.
That seems insanely low. If 30 is oversold, 13 must be catastrophic.
It's extreme.
Yeah.
You rarely see established, profitable companies with an RSI of 13. It suggests panic selling. It implies that the rubber band has been stretched to its absolute limit downward.
It tells us that investors aren't just selling based on logic, they're selling based on fear.
Exactly.
But the report also flags something about the volume. It says volume is moderate to low.
And that's the worrying part. Usually when a stock hits a bottom, you want to see a massive spike in volume. That's called capitulation. Everyone gives up, sells, and then big institutional investors swoop in to buy the bargain.
But we aren't seeing that.
No. The low volume suggests that while people are selling, there isn't a stampede of buyers rushing in to pick up the pieces yet. The smart money, the big funds, are still on the sidelines watching. They aren't convinced.
That's scary. It suggests the market thinks the price could go even lower. Is it possible the market sees something the financial report is hiding? What could they be worried about?
That is always the fear. Markets are forward-looking mechanisms. The investor presentation tells us what happened in the last 6 months. The stock price is trying to tell us what will happen in the next 6.
So let's speculate. What are the ghosts in the machine here? Is it valuation?
Valuation is the likely culprit. Even at 484 rupees, if growth slows down even a tiny bit, the market punishes high PE stocks. But there's another structural risk we need to talk about, the franchisee model.
Right, they call it asset light.
Mm-hmm.
They don't own most of the stores. Franchisees do.
Correct. In good times, this is amazing. VEDANT Fashions collects the cash, and the franchisee pays for the rent, the electricity, the staff. It keeps VEDANT's balance sheet clean.
But it relies entirely on the health of those franchisees.
Ah, you see, it transfers the risk. Exactly. If store sales dip, or if rents in places like Mumbai or Delhi skyrocket, the franchisee feels the pain first.
I see.
VEDANT might still look profitable on paper, but if franchisees start losing money, they stop ordering new stock. Or worse, they shut down. Then that asset-light model suddenly becomes a liability.
Because your distribution network crumbles.
The market might be worried that the franchisees are being squeezed, even if the parent company looks okay for now.
Or maybe it's competition. The wedding market is huge. I know the Tata Group and Reliance are both making moves into ethnic wear with brands like Tasva and Avantra.
That is the elephant in the room. Manyavar had a free run for a decade. They were the only organized player. Now they're fighting giants with deep pockets.
And Tasva is aggressive.
Very. They're coming for that market share.
But Manyavar has the brand recall. The presentation talks a lot about their marketing. Jab apt Tayar, home Tayar. They use huge celebrities. They're trying to sell an emotion, right? Not just a Sherwani.
And that emotional connection is real. They've successfully positioned themselves as the brand for Indian celebrations. That's hard to displace. But investors are fickle. They see Tata entering the ring and they get nervous.
They worry that Manyavar will have to start discounting.
Which would destroy that beautiful 66% margin.
So is there any hope in these charts? Or is it all doom and gloom for the bulls?
Well, that RSI of 13 we talked about, That's actually the glimmer of hope.
How so?
When a stock is that beaten down, the selling pressure often just exhausts itself. Everyone who wanted to sell has already sold.
There's nobody left to sell.
Exactly. The technical report notes that because the RSI is historically low, some analysts are watching for a technical bounce or an inflection point,
A dead cat bounce.
potentially, or a genuine reversal. The current price of around 484 is sitting right at a 52-week low support zone. If buyers step in here because they see the value in those fundamentals, the recovery could be significant.
How significant?
The report mentions targets of 746 or even 807 rupees.
That's nearly a doubling from here. That's the kind of upside that makes people greedy.
It is, but remember, the chart says the trend is still down. Until the price breaks above that 50-day average of 579 rupees, the bears are still in control.
Trying to buy now is what traders call catching a falling knife.
Can be profitable, but you might lose a finger.
So let's try to summarize this strange situation. On one hand, we have a company with 66% gross margins, growing sales, a dominant market share, and a pristine balance sheet.
And on the other hand, we have a stock that has decimated shareholder value, falling from 1,400 to 484, with technical indicators screaming that the momentum is dead.
It really is a paradox. The company refuses to discount its products to maintain its prestige.
But the stock market has discounted the company's value by 65%.
That's the irony.
The market is treating the company like it's on the clearance rack, while the company acts like it's Louis Vuitton.
And that's the thought I want to leave our listeners with today. Who is right? Is this the bargain of the decade, buying a monopoly at a fire sale price because the market is panicking?
Or does the market see a structural crack, maybe in franchise health or changing consumers, that the financial reports haven't revealed yet? It's the ultimate test of conviction.
If you believe in the numbers, you buy. If you believe in the trend, you run. Keep your eyes on that 484 rupee level, folks. It's going to be an interesting week. Thanks for diving in with us.
Always a pleasure.